Earlier this month, 136 countries agreed to comprehensive changes to the international tax system that will levy a 15% minimum tax rate on some multinational enterprises to prevent them from keeping profits in low-tax countries. Now, related talks were also held last week in Washington during the G20 finance ministers and central bank governors meeting, which Seoul's Finance Minister Hong Nam-ki attended. For more, I have Professor Song Soo-young from Chung-Ang University. Welcome back, Professor Song.
Thank you. My pleasure.
I also have Professor Cho Hee-kyung from Hongik University. It's a pleasure to have you, Professor Cho.
It's a pleasure to be here.
Professor Cho, we'll start with you then. Let's begin with some background information behind this landmark approach to global tax reform amid the dramatic changes, economic changes that is, brought on by globalization and digitalization.
Well, indeed, it is a dramatic sea change, you could say, because the current international tax regime was agreed more than a century ago. And it just doesn't have the tools to deal with the globalization and digitalization of the world economy, as you mentioned. So, for example, currently, under the existing tax regime, if you are to have a tax liability in a place, you have to have some kind of physical connection with that place. So for a natural person, it would be your residency, that you actually reside in that particular place for a certain period of time, usually more than half a year. I actually know of some people, of some multimillionaires who spend more than half the year on a yacht traveling around the world so that they don't actually establish any tax residency anywhere in the world, essentially to minimize their tax liability. And so for corporations, they also have to have some kind of physical presence, whether it be having an office, having personnel, and in a brick and mortar world, it was natural to have a shop where you sold things to customers, to have salespeople there, etc. But in a digital economy, you can do everything online. The service can be based, somewhere in Uzbekistan, for all you know, and you can still provide services in Korea, in Japan, Singapore, wherever in the world. And so it's become so much easier for these big corporations, multinationals, to avoid tax liability in countries where they earn huge profits, but they don't actually end up paying any tax. So this new regime is really intended to deal with that problem.
Right. And keeping in mind what Professor Cho has just said, Professor Song, to offer our viewers a better understanding about the importance of this planned reform then, could you perhaps take the example of Google and Korea's Naver here in the country to compare their sales revenue here in the country and their related taxes?
Yeah, according to the report and the information available, that Google has been known to earn the almost 4 trillion and 5 trillion Korean won in our country. Globally, Google has estimated to earn the total revenue is 212 trillion Korean won. But however, if this Google has been, they must make some corporate tax income taxation, corporate income tax in Korea. They are supposed to pay the nominal corporate tax rate is 25%, so which is equivalent to almost 2.8 trillion Korean won. So, but however, they do not pay that because most of their revenue is reported in Singapore, because they argue that they derive the data and provide the services to Korea through the Singapore. Therefore, the total taxation is dramatically reduced, and that is only 9.7 billion Korean won, which is just almost how much is it out of the 280 billion won? So that is really dramatically one fifth. So just 2% of they are supposed to pay. So that is really problem. So because as Professor Cho mentioned, that the big tech companies, through the digitalization, they have provided digital services, goods, and the platform around the world through the internet. However, they do not pay the taxes where they earn their revenues. That is a really problem.
Right. So, Professor Cho, what changes then are we likely to witness in the wake of this global tax reform, which we expect to go into effect by the year 2023, I believe?
Yes, that's the intention. So This reform is intended to address two main strategies that companies use to minimize their tax liability. First is what's called base erosion. That's basically reducing or actually getting rid of their presence in a higher tax country. And the second is profit shifting. Shifting their profit to a jurisdiction where they have lower tax rates. So, for example, Google, Professor Song mentioned that they divert revenues that they earn in Korea through to Singapore because the corporate tax rate here in Korea is 25%, whereas in Singapore it's less than 17%. And Google argues that because we have our servers in Singapore, we are providing services to Korea out of Singapore, and therefore the revenue should be counted, through the Singaporean subsidiary. And in around the world, there are some tax havens like Panama, these little islands, but there are also other countries like Ireland and the Netherlands that have actually competed to have these multinationals come and set up their headquarters in their countries by offering very, very low tax rates. So, for example, Ireland on its face, on paper, imposes 12.5% corporate tax. But because they give so many exemptions, the actual tax rate that corporations pay is between 2% and 4%. It's a fraction of what they would have to pay in Korea, for example. So Facebook diverts all the revenues that they earn from advertising on Facebook Korea through to Facebook Ireland, and they hardly pay any tax. In fact, they paid almost no tax until 2019, and then there was so much protest that they actually agreed to start paying some. The Netherlands, they have the same corporate tax rate as Korea, 25%. But what they do is exempt all overseas subsidiary earnings that are diverted through to Netherlands from tax altogether. So, if you have a company that's headquartered in the Netherlands, and you can bring back all the revenues from other countries through to Netherlands, you don't have to pay any tax on those overseas earnings. And it's possible to do that through what's known as transfer pricing. So it's basically when companies do transactions between themselves. So mother company and the daughter company. So Google, Alphabet parent company might own the license, the trademark Google, and then it would license that trademark to Google Korea, Google Ireland, Google, Netherlands, whatever, and then they would charge enormous sums, for that license, and so the expense becomes huge, and that way they actually get the license fee as the revenue from that subsidiary, and in that way they essentially shift profit from that jurisdiction where they actually earn the revenue to the lower tax jurisdiction. So now what this new regime does is avoid base erosion by saying, even if you don't have any physical presence in the country, we are going to allow those countries to tax these corporations on a certain amount of profit that they make. And secondly, they also make sure that countries will impose a minimum corporate tax rate of 15%. So you can't have a race to the bottom in order to try to compete to bring companies to your own jurisdiction.
As is the case over in Ireland then.
Exactly, yes.
Right. Professor Song, then, do tell us a bit more about the companies that are likely to be affected by this unified approach to taxation.
Yeah, actually, Professor Song mentioned the Pillar 1 and Pillar 2, that was under the auspice of the OECD. 136 countries agreed upon the imposition of a global minimum corporate tax rate, and also the sharing rule among the extra profit that is earned by some multinational enterprise. Also, currently it is going to be applied to some digital companies, but as well as it is easily extended to the multinational enterprise, such as a big corporation, manufacturing corporation, Hyundai Motors, or other big manufacturing companies who has recorded the sales revenue around the world. So to that regard, Samsung and the Hyundai Motor Company, currently Samsung and the SK Hynix is mostly influenced directly. But however, I believe that because in Korea we have the nominal corporate tax rate is 25%, and through the tax exemption and the benefit allowed for those companies, and the effective tax rate is 17%, around something there. So as Professor Cho mentioned, Ireland has also their nominal tax rate is 15%, but actually they just deduct most of the income, and therefore it ends up with almost near to 0% and 3% or something. So to that regard, even despite the deduction and the benefit, still our corporate taxation has satisfied a little bit higher than 15%, so not much affected. That is Prime Minister, Vice Prime Minister Hong Nam-gi has mentioned that. So rather we could earn the benefit because Google or big tech companies, they have expanded Netflix and expanded their business in Korea, and so to that regard, I think the net benefit is a little bit larger than 0 for Korea, but still we have to wait and see because we have so many obstacles to overcome to implement those rules.
Right. In talking about the obstacles, Professor Cho, I was actually going to ask you, so despite the overall consensus among the 136 countries, I do understand, like Professor Song has said, there are many technical and implementation issues that remain unresolved. Could you elaborate a bit on that?
Exactly. I mean, they really face a lot of hurdles before we actually see this happen in reality. So first of all, just this minimum tax rate of 15% that they've agreed on. In fact, they say that there was a consensus, there was an agreement on this rate, but there was a lot of argument about, what the minimum corporate tax rate should be, because a lot of people felt that 15% is simply too low. Even United States, up until 1993, actually used to have something like 38% corporate tax rate, and a lot of countries around the world have corporate tax rates in the 30% range, and not even lower than 25. And so this 15% is thought to be too low by a lot of people. Still, some are advocating for it should be at least 25, if not 20. And so there is that sort of debate still hanging over. And then America has finally joined the fray because this kind of minimum corporate tax regime for globally had been debated for a long time, but America was never really interested in it until they really had to raise a lot of revenue because of all the spending that they had to do because of the pandemic. So America is on board, but the treaty will actually have to pass through the both houses of the Congress, in the states, and so the legislative pathway is not going to be easy. And then there are other things like this is actually not the end of the story, because there are no real details about what kind of exemptions would be allowed or would be disallowed. And so, as people say, devil is in the detail, and we don't really know the detail. We just have some vague picture of what it should be, but no real nitty-gritty as to how it is actually going to work.
Right. So the milestone here is that they've just agreed for the need for this unified approach.
The big principle, yes.
Right. Professor, so you touched upon this earlier, but could you tell us a bit more about the potential impact of this global tax reform on the local economy?
Particularly for the Korea, there is not much, but because we have noticed that the 136 countries has agreed upon that rule, and also majority of these member countries who has agreed on are just developing economies and less developed countries. Out of the 140 countries, Sri Lanka, Pakistan, and Kenya, and 4 countries disagree. But the basic reason is because they would like to just maintain the digital taxation, digital service taxation, because that is a source of the government budget and earning. However, in this new Pillar 1 and the Pillar 2, the global minimum tax rate is imposed, then the digital service taxation should be removed. Because when you look back the history, because in Europe, the 5 countries, so-called digital 5 countries, UK, France, Italy, Spain, and
Austria.
Austria.
Yeah, Austria, right. So those 5 countries always they started the implementation of the levy on the digital taxation, but it is regarded as a sub-value-added taxes, and the U.S. and regarded as a retaliatory tariff against their big tech companies. So that could cause some kind of a vicious circle or vicious spiral of competing with each other, because the digital tax rate is increased So that is a really chaos. It is going to be a chaos from the OECD perspective. So that's why OECD has they try to make some initiative movement, and then United States also realized that this matters a lot, because when they try to provide some benefit to the big tech and the multinational enterprise for US, but they have established some headquarters outside the US. So domicile is outside the US, and that does not help at all to the US government. So that's why the United States push this agenda and achieved some agreement. So in the local economy overall, because the extra taxation which was evaded and avoided and only belonged to big tech companies, for example, Zuckerberg's pocket, the money that should be taken out of his pocket and distributed among the countries. And so that's why I expect this local economy would be beneficial ultimately.
Right. Well, ultimately, it's to ensure the people of paying, that is, their fair share of the taxes. All right, Professor Song, as always, thank you very much for your insights. Professor Cho, as always, it's been a pleasure.
Thank you.
Thank you.